Today, we have something really special lined up for you. We're talking about the timeless wisdom of Warren Buffett, one of the most legendary investors of our time. So, grab a seat, get cozy, and let's jump right in. 1. Holding stocks for the long haul. When it comes to investing in stocks, Warren Buffett, one of the most successful investors of all time, has some valuable advice. He compares investing in stocks to tending to a farm, emphasizing the importance of a long-term perspective. Buffett suggests that investors should be prepared to hold onto their stocks for an extended period, much like nurturing a plant into a strong oak tree. This means being patient and resilient, ready to weather the ups and downs of the market without getting swayed by short-term fluctuations. For Buffett, investing in stocks is not about quick gains or trying to time the market. It's about making informed decisions based on a company's fundamentals and long-term potential. By adopting this mindset, investors can avoid the pitfalls of emotional decision-making and focus on the underlying value of the businesses they are investing in. This approach requires discipline and a willingness to stay the course even when faced with uncertainty or market volatility. In essence, Buffett's philosophy on investing in stocks revolves around the idea of patience, perseverance, and a focus on the long term. By treating your investments like a growing plant that needs time and care to flourish, you can build a strong portfolio that stands the test of time. So, before you dive into the world of stocks, take a page from Warren Buffett's book and remember that successful investing is a marathon, not a sprint. 2. Riding the waves. When you invest in stocks, it's like riding a roller coaster. Warren Buffett suggests staying calm when your stocks drop in value. It's natural for stock prices to fluctuate, so don't panic. Instead of selling in a panic, consider holding onto your investment and waiting for the market to recover. Remember, successful investing is a long-term game, and short-term fluctuations are normal. Warren Buffett's advice is to have confidence in your investment decisions. Even if your stocks take a hit, it's important to trust in the research and analysis you did before buying them. By staying focused on the long-term potential of your investments, you can avoid making hasty decisions based on short-term market movements. Keep in mind that the stock market can be unpredictable, but over time, it tends to trend upwards. Patience and a steady hand can often lead to better returns in the long run. It's essential to have a diversified portfolio to help cushion the impact of market fluctuations. By spreading your investments across different sectors and asset classes, you can reduce the risk of being heavily affected by the performance of a single stock. Diversification can help you weather market downturns more effectively and potentially improve your overall returns. Remember, investing in stocks involves risks, but with a well-thought-out strategy and a long-term perspective, you can navigate the ups and downs of the market successfully. 3. Index funds versus active management. Index funds and active management are two popular investment strategies, and Warren Buffett is a highly respected investor and is a strong advocate for index funds. The reason behind this is their simplicity and effectiveness. Index funds are a type of investment vehicle that aims to replicate the performance of a specific market index, such as the S&P 500. This means that instead of trying to beat the market, index funds aim to match the market's performance, which is a more achievable and reliable goal. The primary advantage of index funds is their low cost. Since they are designed to passively track an index, they require less research and management than actively managed funds. This means that the fees associated with index funds are significantly lower than those of actively managed funds. Over time, these lower fees can result in higher returns for investors. Additionally, index funds provide broad market exposure, reducing the risk associated with investing in individual stocks. Active management, on the other hand, involves a fund manager actively selecting investments and making decisions on when to buy and sell. While this approach may lead to higher returns in some cases, it also comes with higher costs and a greater risk of underperformance. In fact, studies have shown that the majority of actively managed funds underperform their respective benchmark indices over time. This is why Warren Buffett recommends index funds for most investors. By keeping it simple and investing in a low-cost index fund, investors can achieve reliable returns without the need for active management. In conclusion, when it comes to investing, it's important to consider the pros and cons of index funds versus active management. While active management may lead to higher returns in some cases, it also comes with higher costs and a greater risk of underperformance. On the other hand, index funds offer a simple and effective investment strategy that can provide reliable returns over time. By following Warren Buffett's advice and investing in a low-cost index fund, most investors can achieve their financial goals without the need for active management. 4. The lowdown on stock buybacks. Stock buybacks are a way for companies to return cash to their shareholders. It's like when a company has some extra money and decides to give some of it back to the people who own a piece of the company. Warren Buffett is a fan of stock buybacks, but he has a specific way he likes to see them done. Buffett believes that companies should only buy back their own stock when it is undervalued. This means that the company should only buy its stock back when it is being sold for less than it is actually worth. The idea is that if a company buys its stock back at a lower price, it is getting a good deal and creating value for its remaining shareholders. This approach is in contrast to companies that buy back their stock at any price, without considering whether it is a good value. Buffett argues that this is not a good use of a company's cash and can actually harm shareholders in the long run. By being selective about when to buy back stock, Buffett believes that companies can create more value for their shareholders and make better use of their cash. In short, stock buybacks are a way for companies to return cash to shareholders, and Warren Buffett believes that they should only be done when the stock is undervalued. This approach can create more value for shareholders and make better use of a company's cash. It's a simple concept, but one that can have a big impact on a company's financial health and the value of its stock. 5. Berkshire's performance and future outlook. Berkshire Hathaway, the multinational conglomerate holding company led by Warren Buffett, is a force to be reckoned with in the business world. Although its performance may not always outshine the S&P 500, Buffett's unwavering faith in his company is a testament to his strategic vision and commitment to its success. With a staggering 99% of his personal fortune invested in Berkshire, Buffett's confidence in his company's potential is unparalleled. Berkshire Hathaway's core businesses, which include Burlington Northern Santa Fe, BNSF, railway, insurance, and energy, are the backbone of its operations. BNSF, one of the largest freight railroad networks in North America, is a critical component of the company's transportation and logistics capabilities. Meanwhile, Berkshire's insurance operations, led by GEICO and other subsidiaries, provide a steady stream of float, premiums collected before claims are paid, that can be used to invest in other opportunities. Lastly, the energy division, which includes Berkshire Hathaway Energy, is a significant player in the power generation and distribution sector, further diversifying the company's revenue streams. While past performance is an essential factor in evaluating a company's success, Buffett's focus on the long game is what truly sets Berkshire Hathaway apart. By building a solid foundation of core businesses and continuously seeking new investment opportunities, Buffett has positioned Berkshire for long-term growth and success. With a proven track record of strategic acquisitions and a keen eye for value, Berkshire Hathaway's future looks brighter than ever. Well, folks, that's a wrap for today's video. I hope you enjoyed diving into the investing wisdom of Warren Buffett as much as I did. Remember, when it comes to investing, patience is key. So stay calm, stay informed, and keep those investments growing. Don't forget to like, share, and subscribe for more nuggets of wisdom. Until next time, happy investing.